What you witnessed over the last 24 hours was not a normal market correction. It was not the end of the silver bull market. It was not a failure of fundamentals. And it was certainly not random. It was a design event, a short, violent liquidity flush meant to do one thing: force weak holders out of the market and transfer their positions to stronger hands. Let's break down exactly how it happened. The move began with speed. Silver dropped nearly 8% in a single session, slicing through key psychological levels with almost no resistance. Headlines immediately followed. Words like crash, collapse, and bull market over dominated the narrative. This is not accidental. Modern markets move on perception first and logic second. When price falls fast enough, fear overrides analysis, and fear creates sellers. The first group to sell was predictable: leverage retail traders. These are participants using margin, options, or short-term leverage. They cannot afford volatility. Their positions are fragile by design. When price moves sharply against them, they are forced to act, either by margin calls or automated stop-loss orders. And those stop-loss orders matter. In this case, a massive concentration of stops sat just below the $72 to $73 zone. That level was visible to every institutional desk, every algorithm, and every liquidity provider in the market. Once price was pushed into that zone, the outcome was inevitable. Stops triggered in waves. Sell orders cascaded. Liquidity evaporated. At that moment, the chart looked terrifying. But structurally, this was exactly what the system needed. Why? Because institutions cannot buy unless someone is willing to sell. At $80, there were no sellers. At $78, there were very few. At $72, panic created plenty. This is the core mechanic of the bear trap. Price is pushed down not because value has changed, but because liquidity is required. The market must shake the tree to make supply fall. And yesterday was a shake. Another critical accelerant was algorithmic trading. Commodity markets today are dominated by CTAs, commodity trading advisors, essentially momentum-driven algorithms. These systems do not analyze fundamentals. They respond to price levels, trend breaks, and volatility signals. When silver broke below key support, the algorithms flipped from buy to sell. They did not sell cautiously. They sold aggressively and mechanically. Billions of dollars in futures contracts were dumped into a falling market, amplifying a move far beyond what human traders would normally execute. This created the illusion of a structural collapse. But illusions are powerful. Retail traders saw the red candles. They saw gold falling alongside silver. They saw bond market stress and liquidity headlines. The emotional conclusion was obvious. Something is breaking. And that is exactly what the market wanted them to believe. Because while retail was selling, institutional desks were watching volume, not emotion. They saw contracts being dumped at prices well below fair value. They saw leverage being washed out. They saw an opportunity. This is where the trap closes. Once the bulk of forced selling had occurred, the market no longer needed to go lower. The selling pressure was exhausted. At that point, only two groups remained: strong hands and buyers. And buyers stepped in quickly. The reversal was violent because it had to be. As price reclaimed $73 and then $74, the same algorithms that sold the market were forced to reverse. Momentum flipped. Sell signals became buy signals. This created a double buying effect. Algorithms were buying to cover shorts and buying to establish new long positions at the same time. Institutions were adding exposure. Weak hands were gone. That combination produces vertical price action. And that is exactly what we saw. Now, it's critical to address one misconception. A real market breakdown leaves damage behind. Production halts. Demand collapses. Supply suddenly expands. None of that happened here. Industrial demand for silver did not disappear overnight. Mines did not discover massive new deposits. The dollar did not become sound money. The only thing that changed was sentiment, and sentiment is the most temporary force in markets. This is why the recovery was so fast. The price simply snapped back to where value already existed once artificial selling pressure was removed. Another important signal came from the physical market. During the crash, dealer premiums did not fall. In many cases, they rose. This is critical. If the market were genuinely broken, physical sellers would have flooded the market. Premiums would have collapsed. Inventory would have piled up. The opposite happened. Physical buyers stepped in aggressively. Industrial demand absorbed paper selling. A real price floor formed beneath the futures market. This tells us something important. Paper markets attempted to move lower, but physical reality refused to follow. That divergence is the signature of a bear trap. From a technical perspective, the damage was minimal. Yes, price briefly dipped below key moving averages, but it reclaimed them almost immediately. In technical analysis, speed matters. When a support level is lost and then recovered within a single session, the move is classified as a fail breakdown. Fail breakdowns are bullish. They trap short sellers. They strengthen support. They reset momentum indicators without breaking trend. That is exactly what occurred here. The market flushed leverage, cooled indicators, and removed speculative excess, all without damaging the underlying structure. This is not weakness. This is maintenance. The final piece of the puzzle is psychology. Markets do not exist to reward conviction. They exist to exploit discomfort. The sharp drop created fear. The recovery created relief. But relief is dangerous because it leads to complacency. The real lesson of this event is not about price. It's about positioning. Those who were over-leveraged were punished. Those who panicked were removed. Those who understood the structure held their ground. This is how bull markets advance. Not in straight lines, but through traps, tests, and transfers of ownership. What happened was not the end of the silver bull market. It was a stress test, and the market passed. The speed of silver's recovery caught many people off guard. After a brutal sell-off, most traders expect hesitation, days of consolidation, uncertainty, and fragile bounces. Instead, silver reversed sharply and reclaimed lost ground almost immediately. That kind of move does not happen by accident. It happens when multiple recovery mechanisms activate at the same time, creating a powerful feedback loop that overwhelms remaining sellers. To understand why silver snapped back so quickly, we need to look beneath the surface, at the mechanics most investors never see. The first engine of the recovery was forced short covering. During the sell-off, short positions expanded rapidly. Momentum traders, CTAs, and speculative funds all pressed their bets as price broke support levels. In a falling market, this is normal behavior. But short positions come with a built-in vulnerability. They must eventually be closed. As soon as silver stabilized and stopped making new lows, the risk for shorts increased dramatically. Every tick higher represented potential loss. When price pushed back above key intraday resistance levels, stop losses on short positions were triggered. This turned sellers into buyers. Covering a short position requires purchasing the asset, and when many participants attempt to cover simultaneously, the result is explosive upward movement. This is why the rebound was not gradual. It was compressed. The second recovery engine was algorithmic momentum reversal. Most modern commodity markets are dominated by systematic trading models. These models do not think. They respond to signals, trend breaks, volatility compression, and moving average crossovers. When silver recovered above short-term trend lines, the same algorithms that had been selling aggressively were forced to flip direction. In other words, the machines reverse themselves. This matters because algorithms trade in size. When they flip from short to long, they do not ease in. They deploy capital immediately. That sudden shift created a surge in demand that retail traders often mistake for mystery buying. It wasn't mysterious. It was mechanical. The third engine was gold stabilization. Silver rarely moves in isolation. It is a high beta extension of the gold market. When gold stabilizes, silver tends to amplify the move. During the sell-off, gold experienced pressure, but critically, it never broke down structurally. Key support levels held. Volatility in gold remained contained. Once gold stopped falling, silver's downside narrative collapsed. At that point, the relative undervaluation of silver became obvious to institutional desks. Funds seeking precious metals exposure began rotating back into silver for its greater upside potential. Silver doesn't just follow gold, it magnifies gold direction. And when gold stopped falling, silver had no reason to stay down. The fourth engine of recovery came from the physical market. This is the most misunderstood aspect of silver pricing. Futures markets determine the headline price, but physical markets determine long-term direction. During the crash, something unusual happened. Physical demand did not weaken. In fact, in several regions, premiums increased. Industrial buyers stepped in. Manufacturers secured supply. Dealers reported steady to rising demand rather than liquidation. This created a hidden floor beneath the paper market. When futures prices fell too far below physical equilibrium, arbitrage opportunities emerged. Buyers stepped in, knowing they could acquire silver below replacement cost. This is why paper selling hit a wall. Physical reality asserted itself. The fifth recovery engine was liquidity re-entry from institutional capital. Large funds do not chase momentum. They wait for stress events. Sharp sell-offs provide exactly what institutions need: volatility, volume, and emotional selling. As leverage was flushed from the system, institutional buyers began adding exposure, not because they were guessing, but because risk had been reduced. Volatility creates opportunity. And once risk normalizes, capital flows back in. This reentry is subtle. It does not appear as a single massive buy order. It shows up as persistent demand, shrinking bid-ask spreads, and rising open interest on the long side. These signals were present during the rebound. The sixth engine was technical confirmation. Markets are governed by levels. When silver reclaimed broken support zones, those levels flipped into support once again. This shift changed the entire risk-reward profile for traders. What had been resistance became a launch pad. Technical traders who had been waiting on confirmation entered long positions. Swing traders added exposure. Trend followers reestablished positions. Each group reinforced the move. This is how recoveries accelerate, not through hope, but through alignment. Another overlooked factor was time compression. The faster a market drops, the less time participants have to reposition. When recovery begins quickly, many traders are caught flat-footed. They sold near the lows. They missed the bottom. They are now waiting for a pullback that may never come. This creates latent demand. Every dip becomes a buying opportunity. Every consolidation attracts new capital. The market climbs not because everyone is confident, but because many are underexposed. That imbalance drives price higher. Finally, there's psychology. Fear creates imbalance. Confidence restores order. Once price stabilized, the panic narrative lost credibility. Headlines softened. Social sentiment shifted. Traders who had exited began reconsidering their decisions. But re-entry is always harder than exit. This hesitation fuels momentum. The market moves up not because belief is strong, but because disbelief lingers. This is the true engine of recovery. Silver did not rebound because the story changed. It rebounded because the structure reasserted itself. Supply remained tight. Demand remained intact. Leverage was reduced. Momentum reset. The crash was a stress event. The recovery was a confirmation. And together, they strengthened the foundation of the trend. This is how durable bull markets are built. Not through smooth climbs, but through violent tests that eliminate fragility. Silver passed its test, and the recovery was the proof. The most important question is no longer what just happened. The real question is what happens next. Markets reveal their future direction not during moments of calm, but after stress events. The recent silver volatility was not random. It was a structural reset, and resets create opportunity. As the market moves into the January window, several forces are quietly aligning. These forces don't make headlines, but they shape outcomes. The first force is the January capital cycle. Institutional money does not move continuously throughout the year. Capital deployment follows schedules. Budgets reset. Allocations reopen. Risk parameters are recalibrated. January is historically one of the most active months for new positioning. Funds that reduce exposure during volatility events often return with fresh mandates. Commodity desks reassess inflation hedges. Asset managers rebalance portfolios after year-end reporting. This creates a baseline of demand that did not exist during the sell-off. Importantly, this capital is not emotional. It is systematic. When it enters, it tends to stay. The second force is industrial restocking. Silver is not just a financial asset. It is a critical industrial input. Manufacturers do not speculate on price. They secure supply. After price volatility, procurement departments act. Contracts are reviewed. Inventory buffers are rebuilt. This is especially relevant in energy, electronics, and advanced manufacturing sectors, where silver usage is non-optional. Once restocking begins, demand becomes price-insensitive. Buyers step in regardless of short-term fluctuations. That removes downside elasticity from the market. The third force is structural supply tightness. Silver supply is constrained in ways that price alone cannot quickly resolve. Most silver is produced as a byproduct of other metals. That means higher silver prices do not immediately lead to increased output. Mining projects have long timelines. Refining capacity is limited. Environmental and regulatory constraints slow expansion. At the same time, above-ground inventories have been steadily drawn down. This creates a situation where demand can rise quickly, but supply cannot respond. That imbalance does not produce smooth price moves. It produces pressure. The fourth force is global demand diversification. Silver demand is no longer concentrated in a single market or currency zone. Asia, the Middle East, and emerging economies are playing an increasingly important role in price discovery. Regional premiums and arbitrage gaps reflect this shift. When demand becomes global, price becomes harder to control. Local interventions lose effectiveness. Paper pricing mechanisms face stress. This decentralization strengthens a trend. The fifth force is bank positioning risk. Large financial institutions manage risk, not narratives. Periods of extreme volatility force reassessment. Short positions that appear profitable in stable markets become liabilities when physical constraints tighten. As silver prices move higher, banks must choose between absorbing losses or reducing exposure. This does not require a dramatic short squeeze to matter. Even gradual de-risking adds consistent upward pressure. Risk management becomes a buyer. The sixth force is technical structure and price discovery. After a violent reset, markets often enter a new phase. Key levels are established. Volatility compresses. Breakouts carry more weight. In silver's case, the failed breakdown reinforce support zones and redefine resistance levels. This creates clearer pathways for price movement. Once price enters discovery mode, traditional anchors lose relevance. Targets expand. Movements accelerate. The seventh force is macro uncertainty. Silver thrives in ambiguity. Inflation uncertainty, currency instability, and geopolitical tension all enhance silver's appeal as both an industrial hedge and a monetary asset. Unlike assets dependent on growth or policy support, silver benefits from instability itself. It does not require a perfect environment. It requires uncertainty. And uncertainty remains abundant. The eighth force is investor positioning psychology. After volatility, investors tend to underallocate. They wait. They seek confirmation. But confirmation often arrives through higher prices. This creates a paradox. The market moves higher because participants are not fully positioned. Every pullback becomes shallow. Every dip attracts buyers. Momentum builds quietly. This is how sustainable trends form, not through enthusiasm, but through reluctance. Looking into 2026, these forces converge. Demand growth is structural. Supply response is slow. Capital flows are cyclical. Risk is asymmetric. That does not guarantee a straight line upward. Volatility will persist. Pullbacks will occur. But the foundation is stronger now than it was before the crash. Stress removed excess. The market is cleaner, healthier, more resilient. Silver's path forward is unlikely to be calm, but it is increasingly difficult to argue that it is fragile. The question is not whether volatility will return. It will. The question is whether the trend survives it. Based on structure, behavior, and fundamentals, the answer is increasingly clear. The road ahead is not defined by panic. It is defined by pressure. And pressure, over time, resolves in only one direction.